Hey guys, welcome to today's video. We have something special to talk about. There are multiple ways to get a rate to buy a home in the fours, and we're going to break it down for you. We have 3 programs we would like to talk about today. So, you guys ready? First, I'm Steve Gonzalez.
And I'm Rose Gonzalez with the Gonzalez Real Estate Team. If you're new to our channel, make sure to give a little love to that subscribe button and click on the notification button so you could be the first to know about what's happening with real estate in the area or even with the market. So, all right, you ready?
So let's start the video. Rose, there are 3 programs you want to talk about today, and they could get you in the fours.
Yeah.
That doesn't make sense to me because interest rates are in the 6s, right?
Yep.
Can you explain what you're talking about?
Yeah, so there are a couple things that I wanted to explain today. So one of them is a 2-1 buy down. So a 2-1 buy down is actually a program that they just recently released, but they used to do this back in the days when interest rates were really high. And what it means is, like, let's say your interest rate is at 6.5% right now. The first year you would get 2% off your rate. So then that would put you
That represents the 2.
The 2. And so you would be at 4.5%, right?
Okay.
Did I do the math right?
6.5 would be let's say you qualified for a loan today, and it's 6.5. If you did the 2-1 program, your interest rate would now be 2 points less than the 6.5, so it'd be 4.5
for the first year.
Yep.
And then the second year would represent the 1, so then your interest rate for the second year would be 5.5. Now, the difference in the payments, so the payment for your 6.5% interest rate and the 4.5% interest rate for the first year, you add the difference together, you'll come up with a cost. And the same goes for the second year. And
that'll be towards the closing cost of when you get the program, you get the loan, and the loan closes, your closing cost. Got it.
So then you would actually need to get a seller credit to cover the cost of this program. And so right now is actually a really good time because...
What if you don't get a seller credit?
Well, they actually require the sellers pay for it because it wouldn't make sense for you to pay this upfront cost to buy down your own rate. It's just, they're doing this to help the buyers get into homes comfortably.
Why would a seller do that?
Well, we're getting a ton of sellers actually doing rate buy downs right now because the market shifted quite a bit. If a house is sitting on the market for, let's say, 60 days now, and the seller needs to move on and go to their new house, they may be getting a discount on their new house. So they're trying to get rid of their current house. So whatever they need to do to make it work. So rather than doing a price drop or asking the sellers to reduce the price, you can ask them for a seller credit instead. So say you're buying a house for $600,000 and you're like, oh, I want to buy it for $580,000. Instead of saying $580,000 price, build in that seller credit and say, hey, I'll buy it for $600,000, but I want a $20,000 credit to buy my rate down.
And so if I buy that house, I am getting, for the first year, 2% less, second year, 1% less, and the seller is going to pay for that loan.
For the cost to buy it down.
Wow.
Right. And the cool thing is that...
So it's kind of a win-win.
Right.
Sellers and buyers.
Yep.
Got it.
And the cool thing is that, experts are predicting that rates are going to go down next year. And so because the cost was paid up front, so let's say you refinance a year later, and so you're in that 1% difference. Since the seller paid for that upfront cost, you can actually get that money back if you refinance. And then you can use that to refinance out of the program, get a lower rate, and use that money that the sellers used to pay up front to pay for the closing costs of your refinance.
Wow.
Yeah.
Sounds like a great program. Yeah, if it all works out, because it's just so much different than it was a year ago, right? Buyers were just struggling to get offer after offer accepted or even looked at. We even wrote some offers on a home ourselves right when it was starting to come up, and they didn't even call us back. I don't even know if they looked at it.
Yeah.
Just so many people were coming in, taking all these houses with no contingencies, all cash, and we had so many buyers during that time that just were looking for so long.
Yeah.
And now things are changing, and we are out there every day looking at these deals and seeing that
New builds are actually also offering, incentives.
anywhere from $10,000 to
Yeah.
$30,000 incentives on using their lender to buy down your interest rate and your closing costs as well. This wasn't the case a while ago. They had a line out the door, and they couldn't care less, get on the waiting list.
Yeah.
So it's good to see these things change. There's
Yeah.
deals out there to be made.
Yeah. So the next option would be a loan assumption. So what a lot of people don't know, that there are loan programs out there that so let's say you wanted to buy a house, and the seller had a VA, FHA, or USDA loan, like a government-backed loan. They can actually call their mortgage company to see if you can take over their mortgage payments and their loan. So you're basically just transferring. So like, let's say I'm a seller, I had an FHA loan, and you're my buyer. Well, I can just pass on my loan to you. You would have to fill out forms with the mortgage company and transfer it over. From what I understand, they still kind of have to look through like credit and all that stuff, but you don't have to do an appraisal. So that, you would assume my interest rate. So let's say when everybody was refinancing last year to like the 3%, and I wanted to sell my house now, I can call my mortgage company and say, hey, can my buyer assume my loan at 3.5%? So that's an option. A lot of sellers don't know this either. So as realtors, we want to spread this information out, because let's say you're out buying a house. You can ask your realtor to talk to the seller's realtor and ask, hey, is the seller's loan assumable? And they'll probably say, I don't know. Well, can you call the seller and ask? That will prompt the seller to call their mortgage company and find out. A lot of people don't know about this. So there are pros and cons, obviously.
Well, can I ask you, are there certain criterias out the gate that we could look for if it would be an assumed loan or not? As far as you mentioned, FHA, VA.
Government-backed loans are usually assumable, FHA, VA, and USDA. Now, a VA may not want to pass on their loan to a buyer. I'm not sure if they'd be able to get another VA loan. So like, I think with VA loans, you can only have one loan at a time. So that's the one thing, is if it's a VA loan, they need to find out if they can use their VA certificate to buy another home if they passed their current loan to someone else, because it's not paid off. So other than that, I believe, it just really depends on the mortgage company.
And it sounds like there's a lot of questions with these programs. What do you recommend if anybody has any questions and wants to dive deeper into a program like this? What should they do? Should they reach out to their lender?
So the loan assumption would be more on the seller. So doing a loan assumption on a home, you would want to talk to your real estate agent that you're working with to help you buy a house. They would then talk to the realtor of the seller, and then the seller would need to call their mortgage company to see if their loan is assumable. So then it's not really like anything outside of that circle. Now, one of the cons to doing this is, let's say you're buying a $600,000 home and the seller's loan is $450,000. So you're taking over the $450,000 at whatever interest rate they have, but now you have.
Let's say 3%. I like that number.
Yeah, I know, me too.
Okay.
But now you have $150,000 gap between the loan that they can pass on to you and your purchase price. So then now you would need to figure out, do you have cash for that down payment, or do you need to borrow gifts, or is there a way you can get a loan? So those are the things that you would need to think about, once it passes over to you, how you're going to pay the difference. So that would be the only, real con to this is just making the difference of your down payment.
How come we don't hear more about this?
Because Well, it's our job as real estate agents and lenders to share this information. And I think a lot of people get so caught up in like media stuff and just the regular day-to-day selling of homes. And all of this is really like new. It's new to us, and we're just sharing things as we find things out. Because we're in a shifting market, it's really just being resourceful and being able to get you guys the information. So, doing a lot of homework on how we can help clients and stuff like that. So that's loan assumption. So number 3 is something that just came out December 1st, and I have to read my notes because this is so new. So this is for conventional loans for first-time home buyers. So it started December 1st, and it's basically you can get up to 1.75% off your interest rate. And this is like something that all lenders have access to. So let's say you qualified for a mortgage, you got pre-approved, and you got a 6.25%. Let's say that's where it's at right now. 1.75% discount would put you in 4.5%. So how it works is on the lender side, they have what they call a rate sheet. So this is basically what interest rates are, and then they have these things on the rate sheet called basis points. And basis points are like just numbers of, things that they charge you as a buyer when you're qualifying to buy a house. So let's say, you have a 720 credit score. You won't have as much cost on your interest rate as someone with a 660 credit score, because someone with a 660 credit score is riskier. So let's say for a 720, your cost on this loan basis points is, let's say, 0.5 or 50 basis points. But if you have a 660 credit score, maybe your basis point cost is 1%. Take into consideration your credit scores, and your down payment. So if you have a 620 credit score, which is already risky, and you're only putting 3.5% down, your basis point cost is pretty high. So this is all something that you'd want to talk to with your lender. It's getting super technical.
My question, when you say 0.5 basis points or 1 point, is that a charge from the lender? Is going to be 1% of the loan amount? So if it's 500.
So I believe it's like off the rate. It's not like percentage of the loan amount.
Okay.
Yeah. So there are 2 programs that offer this with a conventional loan. You have your standard conventional loan program. They do base the income off the area median income, which is like an AMI. So for conventional standard, you can have 100% of the area median income, or in high cost areas where properties are a lot more expensive, like the Bay Area, San Francisco, Los Angeles, you can go up to 120% of the area median income. So again, your lender can talk to you a little bit more about that. There is another one available called Home Ready or Home Possible. This one does also have income requirements, and it's 80% of the area median income. So these are really made for first-time home buyers. And so another question a lot of people have is what is a first-time home buyer, right? So let's say I bought a home 5 years ago, and a couple years later I sold it. I haven't bought a home in the last 3 years, or I'm not on title on any houses for the last 3 years. I will be considered a first-time home buyer. So, this applies even if you bought a home but just has not owned something in the last 3 years. You could be considered a first-time home buyer.
Got it.
Yeah.
So I had a house in 2015, sold it, haven't had one since, rented. I bought a house, I'm a first-time home buyer.
Yes.
Okay.
Mm-hmm. Yep.
Good to know.
So I know this is a lot of information, but these are things that you can talk to your lender about. And if you kind of have a hard time trying to explain the programs that we just talked about, feel free to call us, and we would be happy to do a 3-way call with your lender and explain to them what we are explaining to you, and just really trying to give you guys different options in the market right now.
That's our goal of this video is there's programs out there that whether they're new, whether they've always been there, or they're bringing them back, we want to educate ourselves and you guys out there to know that there's a lot of options out there. So if you guys are in the market to buy a home or even sell a home, I mean, to know that there's these credits you could give as a seller that could entice a buyer to buy your home to get your house sold on the market in a shifting market we're in. That's our goal. Yeah. Give the education out there. You guys have any questions, always feel free to text, comment. You can email us, DM us, all that. We would love to answer any of your questions. So, anything else, Rose?
Well, again,
what?
If you're new to our channel, give a little love to that subscribe button, and we'll catch you on the next video. Bye.
Have a good one.